You're listening to AM Now, an Accounting Matters podcast. I'm Adam Olsen, taking this week's episode solo, kicking things off with a brief recap of the recent FASB meetings held last week on June 12th. In its June 12th meeting, the FASB discussed several matters, including its project on accounting for environmental credit programs, or ECPs, as well as the board's agenda prioritization. In its June 12th meeting, the FASB discussed several matters, including its project on accounting for environmental credit programs, or ECPs, as well as the board's agenda prioritization. On the ECP front, this project has been fast-moving. We've talked about it several times here on the podcast, and this time the board focused on the election of a fair value accounting policy for certain non-compliance environmental credits. Several key tentative decisions were made here, including, as it relates to fair value remeasurement, that entities may elect to remeasure non-compliance environmental credits at fair value if acquired through an exchange transaction or non-reciprocal transfer. They also address disclosure requirements. Entities must disclose qualitative and accounting policy information about their environmental credit programs, and these disclosures should include descriptions of carrying amounts and classifications of significant environmental credit holdings and compliance obligations. Additional disclosures over non-significant environmental credits, cash paid for acquired credits, sales revenue, and costs related to environmental credits are also required. Disclosure requirements will apply to all entities, including those public and private. They also addressed transition guidance in the meeting and noted that the adoption of the ECP guidance requires a modified retrospective approach, which would adjust retained earnings as of the beginning of the effective annual reporting period. Entities must also disclose the nature and reasons for accounting policy changes and their effects. As it relates to changes in accounting policy, the retrospective application of policy changes for subsequent measurement from historical cost to fair value is not permitted. And the FASB also noted that entities must remeasure all relevant credits at fair value, disclosing the nature and reasons for changes. Next steps on this project, after deciding that the benefits of it outweighed the costs, the board instructed its staff to draft the proposed accounting standards update for a vote, followed by a 90-day comment period. At the same meeting, the board also addressed what priorities for its current agenda should be after discussing the results of FASB staff research and analysis on several potential projects. From those discussions, the board decided to add a project on clarifying the guidance for share-based consideration payable to a customer to its agenda. There were several projects the board decided not to add to its agenda in the same meeting. These included the accounting for lease costs incurred during the construction period, the accounting for common interest realty associations, and hedging forecasted bond purchases. On the share-based consideration project, the board moved quickly, making several tentative decisions in the same meeting. Specifically, as it relates to conditions based on customer purchases, they said the definition of performance conditions for share-based consideration payable to a customer should be revised to include targets related to the grantee's purchases from the grantor. For customer awards with service conditions, they decided that the entity-wide policy of accounting for forfeitures as they occur was eliminated. Entities must instead estimate what their expected forfeitures will be going forward. For conditions based on third-party purchases, they revised the definition of a performance condition to now include performance targets based on purchases by third parties who buy the entity's goods or services from its customers. On the variable consideration constraint, they clarified that the variable consideration guidance in Topic 606 does not apply to share-based consideration payable to customers either before or after the grant date. Instead, entities must use Topic 718 to evaluate conditions affecting vesting and fair value. They also addressed transition method and disclosure requirements in their tentative decisions. Amendments here should be applied on modified retrospective basis with an option for retrospective application. Disclosures would be required upon adoption to include the nature and reason for the change, any cumulative effects on retained earnings or equity, and impacts on prior period financial statements, if applicable. Entities that would be issuing interim financial statements must provide required disclosures in the first interim period and the fiscal year of adoption. Next up here, the FASB staff were also directed to draft a proposed accounting standard update for written ballot with a 45-day comment period for this proposed update. Staying on the FASB news, the Emerging Issues Task Force recently met to deliberate the existing accounting guidance for the determination of an accounting acquirer. The task force recommended that the board add a project to its technical agenda to require an entity to consider the factors for identifying an acquirer in the implementation guidance section of ASC 805 when a variable interest entity is acquired in a business combination affected primarily by the exchanging of equity interests. The task force recommended any amendments be applied prospectively and that early adoption be permitted. Now, these recommendations do not change existing GAAP. Instead, the FASB will discuss the recommendations at a public meeting and decide whether to add this project to its technical agenda. Switching over to sustainability updates, a couple episodes ago, we shared that ESMA, the EU markets regulator, released new guidelines for how to use ESG and sustainability-related terms in investment fund names to lower the risk of greenwashing. Earlier this week, the European Council followed suit and announced that it had agreed on proposals to cut down on greenwashing and false environmental claims, effectively wanting to require companies to obtain independent verification on their green claims and labels. The Council will now enter negotiations with the EU Parliament regarding the European Commission's Green Claims Directive, which takes a more aggressive stance by wanting to ban green claims simply on the use of carbon offsetting schemes. We'll see what comes of this as it shakes out here. And closing us out this week, we bring you some exciting news from an Embark key partner, Workiva. If you know, you know. And they recently announced the launch of a new and impressive application, Workiva Carbon, designed to enhance their existing ESG and sustainability platform to support global climate regulations such as the CSRD, SEC climate disclosure rules, and the California climate rules. This new tool will support organizations as they manage their net zero targets, respond to stakeholder demands, and compete globally. Workiva Carbon enables companies to collect real-time data from ERP systems and utility providers to track their GHG emissions across various locations using validated emission factors from over 240 countries, allowing for automated calculation across all three emission scopes as well. It also provides tools for supplier engagement to capture critical data, set science-based targets, assess ESG risk, and decarbonize the supply chain. The platform facilitates collaboration by sharing and linking trusted data across business functions, minimizing the risk for manual edits and multiple spreadsheet versions. Additionally, it ensures consistent emissions data disclosures for regulators, investors, and stakeholders by aligning with voluntary and mandated frameworks and providing full data lineage and evidence. Exciting news there for sure with our friends at Workiva. And that rounds us out for this week. For a deeper dive into what's trending in accounting, finance, and sustainability reporting, check out our other podcasts on the Accounting Matters feed on your preferred listening platform. We'll be taking a couple weeks off here at AM Now to enjoy the summer holidays, but we'll bring you up to speed on all things accounting, finance, and sustainability when we return. For now, I'm Adam Olsen. Thanks for listening to AM Now.